There is a buyer in the stock market that never reads the news, never panics, and never really stops. It bought more than $1 trillion of shares in a single year. That buyer is not a hedge fund, or a pension, or a central bank. It is companies buying back their own stock. This is the story of how the buyback quietly became one of the biggest and steadiest forces holding up the market. Here is why this matters even if you never buy a single stock. Most buyers in the market react to price. They buy more when things look good and pull back when they get scared. Buybacks are different. A company that has announced a repurchase program keeps buying its own shares quarter after quarter, often more eagerly when the price falls, because each dollar buys more stock. That makes buybacks a structural bid, a source of demand that is always there in the background, largely indifferent to the mood of the day. The payoff to grasp early is simple. When you wonder why the market keeps grinding higher despite bad headlines, part of the answer is a buyer that is contractually committed to keep buying. Let's rewind. For most of the 20th century, large-scale buybacks were rare, and companies worried they looked like stock manipulation. That changed in 1982. When a new American rule gave companies a safe harbor to repurchase their own shares in the open market without falling foul of manipulation law. The floodgates opened slowly, then all at once. Over the following decades, buybacks went from a curiosity to the single largest use of corporate cash for many big firms. To see the scale, look at the S&P 500, the 500 largest U.S. companies. For the 12 months ending in mid-2022, their buybacks crossed $1 trillion for the first time in history. Then, for the 12 months ending in September 2025, they set a fresh record of about $1.02 trillion, up from roughly $918 billion the year before. So the question becomes, what does all that buying actually do to the stock you own? Here is the machine, and it is simpler than it sounds. A company's profit gets divided among its shares. Earnings per share is just total profit divided by the number of shares outstanding. Now watch what a buyback does. The company uses its cash to buy back some of its own shares and cancels them. Profit has not changed at all, but the number of shares it is divided among just shrank. So earnings per share goes up, purely from the arithmetic, even if the business sold nothing more. That matters, because so much of how we value stocks is built on earnings per share. A higher number, all else equal, can support a higher price and make growth look faster than the underlying business alone. There is a second effect. Every share the company buys is a real order hitting the market, real demand for the stock. So a buyback pushes on the price from two directions at once. It shrinks the denominator that flatters the earnings math, and it adds a steady, price-insensitive buyer on the other side of every seller. Lego block by Lego block. That is how a company can lift its own share price without growing its profit by a single cent. And because it runs on a schedule, not on sentiment, it keeps working in the background while everyone argues about the news. Here is where it gets concrete, and where the fragility shows. This buyer is enormous, but is not perfectly reliable. Look at the quarterly numbers. In the last quarter of 2024, S&P 500 companies bought back about $243 billion of stock. In the first quarter of 2025, that jumped to a record $293 billion. But the very next quarter it fell by about a fifth, as companies turned cautious amid uncertainty. That is the catch. Buybacks are discretionary. When earnings are strong and confidence is high, the machine runs hot. But in a genuine downturn, when cash gets tight, boards can pause repurchases exactly when the market needs support most. The steady bid that props the market up in good times can quietly step back in bad times, removing a buyer just as other sellers arrive. So here is the lens to keep. Buybacks are one of the most powerful forces in modern markets, but they are a fair weather friend. In calm, profitable years, they are a near constant bid that flatters earnings and cushions dips. In a real crisis, they can fade just when support matters most. So when you look at a rising market, it is worth asking how much of the climb is real business growth and how much is a shrinking share count doing the heavy lifting. And when you brace for a downturn, remember that one of the market's biggest buyers is under no obligation to show up. That is not a prediction about where prices go next. It is a way of seeing which support under the market is solid and which is only there while the weather is good. This channel explains how markets work. It is educational, not financial advice.